Good morning and welcome to the Saxo Bank Morning Call. It is Tuesday, June 18th, 2019, and another day of waiting before tomorrow's very pivotal FOMC meeting. It feels like the market has a lot of expectations around this and a lot of uncertainty. There are some traders out there, some investors looking for them to wax dovish, and others saying we've way overshot what the Fed is actually going to deliver or thinks it's going to deliver. And it's going to mean at least short-term volatility. We'll get to that. For now, let's look at where the markets are. Let's look at Nasdaq 100 here. I think it's a very, very interesting setup. We have, of course, we're just ahead of earnings season starting later in a few weeks in July. But that all-time top there, briefly in May or late April, whenever that actually unfolded there, rejected, and now we've rebounded in the retracement area, the 61.8% retracement area here at 7,500 plus. And this big pause, are we going to see an FOMC meeting that encourages a speculative frenzy to new highs, or is this throwback rally the classic sort of throwback before fresh declines? I think it's a very interesting, it's a bearish setup, I would argue, until we really blast well above the red line there and the top, of course, that we saw earlier this spring. So a big setup there. Now, in terms of economic data we've been getting out of the U.S., it's been pretty jittery. We saw an Empire Manufacturing Survey yesterday. I have a chart here. The information values of these regional manufacturing surveys are very low, but it was noted this was sort of the worst, or the worst decline, I believe it was, in 18 years. It did come after an odd spike higher, so just an interesting one to watch. And note, of course, that we saw a near miss back in late 2015 and into early 2016, when many were calling actually that the U.S. had slipped into a minor recession there before the Fed's easing on policy helped to turn things around back then as well, the dollar easing back. It's going to take some more incoming data. I think that's one of the key tricky bits here is for the Fed. You have, some have argued, two policy rates, one for the economy and one for financial markets. And the Fed is going to have a hard time, I think, navigating which one of these rates it is addressing at that FOMC meeting tomorrow. Let's also look at overnight information. We saw the RBA minutes out, encouraging the view that they're more likely to cut than to hike. As well, a recent speech from an RBA member talking about that the unemployment rate could drop to 4.5% rather than 5% as the level that might start to generate inflation. If we go back to the chart, you can just see how that red line there is showing you the, I've put in the 2-year swaps, the short Australian yields have been just absolutely collapsing. We were back at the beginning of the year, we were still above or around 2%, a little bit lower if you're looking at the official, or if you're looking at actual Australian bonds, and maybe they're around 100 basis points now for the 2-year versus 110, 112 basis points for the swaps. Nonetheless, look at the fall. We've come down almost 100 basis points this year, and the Australian dollar a bit slow to react. I think China propping it up to one on the one side. Some of the commodity prices as well propping it up a little bit as well. But of course, the big slide in the U.S. rate expectations has meant that the spread has not changed terribly over that time frame. Nonetheless, Aussie looking at critical lows. I drew a low on that chart at the very lowest level back from, I believe it was the very beginning of 2016, around 68.27. If we get below that, we're talking about the lowest levels essentially since we were emerging from, or bottoming out during the and emerging from the global financial crisis some 10 years ago. So big levels there for the Australian dollar. I'd like to point folks to a video I shot yesterday, a rather long video looking at the FOMC meeting tomorrow and discussing why it is so pivotal and a lot of the moving parts that are making this so anticipated. Do look for that. You can go just to analysis.saxo. As I'm speaking now, it is the topmost post, so it'd be easy to find there. Otherwise, the URL, full URL is at the top of that slide there. Look for that. I run through some scenarios, how markets might react, and I looked at also where we were. Importantly, this is only the fourth time we're talking about the Fed beginning an easing cycle over the last 20 plus years. So these are monumental sort of shifts in the outlook, and I talk about the last 3 times that we saw the Fed shifting towards an easing cycle. 98, very different from now. We've talked about the 1998 scenario before on this program. 2001 and then the 2007 experiences, of course, were the beginning of something very serious unfolding during those easing cycles. Latest update of the Bloomberg World Interest Rate Probability chart or graph here. Table here shows that we've edged up towards 22.9%. If you look at the column for a rate cut for the June meeting at the top there, and still over 80% for a move by July. So of course the market really strongly expecting either to see the Fed actually cut, and if not, certainly tipping off for a July cut. And there are lots of permutations there. They could do what you could call a hawkish cut. They could go ahead and move 25 basis points, recognizing the market's pressure, but sort of be a little bit cautious on the guidance, saying, well, look, we need to see, for example, stronger dollar, weakening income data, more concern on the trade front before we continue to move further. So there are a lot of permutations here, a lot of different ways they can do it. Nonetheless, the market has priced out considerable or priced in considerable rate cuts from the Fed. In fact, down to 1.5%. If you go back to the table there on that far right column there in blue, you see what's the forward rate. So as we're getting into about a year from now, the June 10th, 2020 meeting, you're talking about the Fed the market anticipating a 1.5% policy rate from the Fed, and that would take the dot plot, if we're going to see a dot plot adjustment tomorrow, to look something like this. I penciled in a line for 2020. That's where we are for June. You can see where the median was, or the approximate median is for the forecasts in March. This is as recently as March. That's how far we've come down here. So we're talking about the median being forced to move down a full 100 basis points on this dot plot if they're to meet market expectations. It's a tremendous shift. Is the Fed going to deliver there? I think Powell, if he could have his preferences, would like to entirely eliminate this dot plot. I don't think he likes it at all as a policy tool, but they could also use the dot plot in this case to indicate that they're on board with market expectations, whether they move or not. And we've also identified gold. I talk a lot about gold in the FOMC preview video. Gold is being a very interesting instrument over this FOMC meeting. I've got a chart here. Of course, we're hitting on those key highs we've talked about so much this week and recently, 1350 to 1375. This is the zone. That 1375 high is, I think, the most interesting, relevant high in the price action since stretching back to about 2014. Are we going to break above there? What is the psychology that drives us? Supposedly, as we see central banks cutting and cutting, we're seeing negative interest rates around the world. We're seeing the risk of QE potentially being restarted at some point, etc. The market thinks that this will somehow be inflationary. Apparently, they have not looked at the historical record. Let's recall gold peaked out in 2011 and has essentially been in an 8-year bear market. There was an awful lot of QE going on from the period of 2011 until now. So it feels to me like the market is not anticipating necessarily what we have seen, the types of policy tools we have seen, but that's the next phase of policy tools. Modern monetary theory, and this sort of fiscal forcing of spending rather than using the central bank balance sheet to buy existing assets and sovereign bonds, corporate debt, etc. So, and interesting, if that is the case, then we need to see these policies coming on board to drive that, and we need to see inflation levels starting to pick up. But interesting to see gold, testing these levels. And of course, you could argue gold is simply a safe haven anyway, but we're not seeing safe haven seeking anywhere else except in treasuries. We're not seeing it very much at all in equity markets. So there's a lot of, I think, dissonance across markets here. It'd be interesting to see how this sorts out in the wake of that FOMC meeting. Now, one final FX chart I want to bring up is the euro sterling chart. We're trading at new highs here, getting really close to actually the 90 level. I'm a bit surprised we've moved so aggressively. It doesn't seem to me any surprises in this Tory leadership selection process. Boris Johnson is the favorite. He is considered in favor of a hard Brexit, or a proper Brexit, if you will. He says he wants to avoid a no deal, but it's clear that he wants to see the UK out of the European Union. An interesting opponent may be developing here that could be his the runoff, the person in the two-person runoff, as the Tory leadership, the Tories actually vote for leader after the June 22nd. After June 22nd, at which point we only have two candidates left. This is Rory Stewart. So it'll be interesting to see. Today sees a vote later in the evening, this evening, to see if there's this sense emerging that there's an interesting or credible opposition candidate that can see at least half of, or close to half of the Tories backing. For now, euro sterling heading into that 90 to 91 area. I think hard time seeing it stretch much further here unless we get some sense of what the EU stance is. Our position is that longer term we potentially see we're rather constructive on sterling relative to the euro as we move towards what we hope would be a managed Brexit and not some no-deal Brexit on WTO terms. We've talked about that before. I also did a brief piece on that as well. Moving to our calendar, We've got a reasonably interesting day. We have ECB's President Draghi out speaking this morning. There's the Sintra ECB forum going on in Sintra, Portugal. Keep an eye on that. There's the sense that the ECB has no policy room left to work with. Is there any sense that he can gin up enthusiasm for their ability to act here? We have the German ZEW survey. There's been an interesting development there. We've seen the expectations point recovering decently back towards zero, whereas the current situation component of that survey has collapsed down to basically to zero or to neutral relative to where it was at very elevated levels. So could be an interesting inflection point to see if those trends diverge again. And we have some U.S. housing data after a somewhat weak NAHB survey yesterday, weaker than expected at least. Of course, the FOMC tomorrow, critical there. New Zealand GDP, very interesting around the Aussie Kiwi rate and Kiwi crosses in general. And then the European Council and this EU Commission candidate selection process, also very interesting. It looks like the German candidate for EU Commission president post is really struggling, and this has led some to believe that Germany will campaign to have the ECB presidency taken by Weidmann, which would be, of course, a very interesting selection, given that he's traditionally been more hawkish and less enthused about these more dovish policies and generous policies towards the entire European Union. So very interesting process going on there in coming months. That's it for today. A bit of a mouthful. We'll be back tomorrow, and I'll run through another couple of bits and scenarios from the FOMC video and talk about that again and update that again in tomorrow's morning call. Thanks for joining.